Good morning. We're live. Welcome to RE Journals, Breaking Through the Disruption. Thanks for joining us this morning. This is probably going to be my favorite webinar we've ever done because it's near and dear to my heart as a former tax person. And frankly, I've known all these guys for a long time. So this should be pure joy for us tax people today. But even for non-tax people, we're going to put it in real plain English. There are really some exciting things in the CARES Act that I think went unnoticed. I'm going to do a couple housekeeping items first as we allow people to log on. Get that slide up. Here we go. This is us. Thank you for joining us, Breaking Through the Disruption. Deeper funding and tax savings in the CARES Act. I want to thank these sponsors, commercial partners, Wipfli, NAI Legacy, IREM, and SIOR. I got to make sure we see the SI. There you go. There you are. And RE Journals. I have to stop and say this every time because we were scheduled to do 104 live events this year. I mean RE Journals. And when this coronavirus hit and we've had to shut down our live events, it's been really hard, and not just our staff, but everybody. And we've been lucky enough to pivot into these webinars. We know it's not quite the same as getting to see all the smiling faces, but without companies like this helping sponsor us, we wouldn't be able to do this. So thank you to all of these groups because you're making a really fantastic webinar series. We're able to get information out to people, and we're really grateful for that. If you have connection issues, there's a button at the top of your screen that says reconnect. You want to make sure to push that button. That's the easiest solution to solve it, and it solves 99% of the problems. If that doesn't work, try using Google Chrome. If that doesn't work, just shut your browser down, open it back up again in the link we sent you, and it should be fixed. I'm showing 5 bars on our end, so I don't have any connection issues this morning, so it's not me, it's you. On the right, you have a chat section. What I want you to do is go in that chat section right now, put in your name, your company you're with, and what state you're from, and then you can network with everybody on there. But more importantly, this is where you're going to be able to ask questions. I suspect there will be a lot of questions of these folks. So pop in your questions right there. I'll mark them, and I'll try to moderate them as they come in. I'll get a poll up, too. We'll do something fun this morning that you can get involved in. We now have our own YouTube channel. At rejournals.com/video replay. So if you miss anything today, you want to send it to any customers, you want to go back and rewatch it, we'll have it up there. We will send you this link again when this is all done and it's put up on our screen live. All right, that said, Jim and Josh, why don't I introduce you guys quick and then I'll turn it over to you for your slides. Jim Lockhart on the bottom of your screen, wave Jim. I've known Jim since the 90s, in the last decade. And he was one of the reasons I went to law school, because I was, trying to figure out how do I make my way in this world, and I want to be one of the smart people. And Jim's been that guy to me for 30 years. So you'll get to hear from him today. He's a great mind. Josh, I don't know as well, but Jim says great things about Josh. He's from Chicago, an accountant. These guys are tax code experts. So when they look at the tax code, they don't see a bunch of jargon. They see opportunities. So, Jim, here's your slides. I'm going to pop them up. Are you ready to go? And Josh?
Yeah. Let's do it.
There we are.
So, okay. So, well, thank you for that really nice introduction, Todd. And like Todd, I've known everybody on this panel for, many years. And it's a great panel. I think everyone on this panel is a creature of the tax code in some form or fashion. But the talent they bring is the ability to put it in plain English and find opportunities for people that own real estate. And what we're going to talk about today are tax law changes that came through the CARES Act, that what we like to call free money. And the free money in the sense that if you own real estate and have paid taxes in the past 8 years, here's an opportunity to go back and get those taxes. So if you own real estate, I would be surprised if there's something here that you can't take advantage of to get additional money under the CARES Act. while the PPP loans and the EIDL loans, those are great programs. And if you qualify, we certainly encourage you to go out and get those loans. But here's another opportunity, and we have clients that we're already working on to get taxes that they've paid that will far exceed anything that they'd ever recover or get through the SBA program. So why don't we flip through this? Oh, there's us. Thank you. And there's a little bit about a firm. One thing I want to say, if you would like these slides, please feel free to provide your email address, and we will certainly get these to you. So here's what we're going to talk about kind of overall today, including all of our speakers, just a brief overview of the CARES Act, but then we're going to dive into these provisions that apply to you, especially if you own real estate, and I bet everybody on here does. So we're going to cover some NOLs, the new rules about that, the excess business loss limitation being gone, qualified improvement property now opened up to qualify for 100% bonus. A lot of you have been hit by the business interest limitation. That's been changed. We're going to hit on some just miscellaneous updates that do apply, and then we're going to get into 1031s and a little bit on opportunity zones. So, Josh, do you want to start us with the first part?
Yeah, let's do it. So, just going to give a brief, high-level overview of the Coronavirus Aid, Relief, and Economic Security Act, aka the CARES Act, which was enacted March 27th. The primary goal was to provide numerous tax and non-tax benefits to both support businesses and individuals alike that have been affected by COVID-19. And many of those specifically have a positive impact on the real estate industry. The provisions will both help reduce taxpayers' current and future tax liabilities, but there's also opportunities for some of these provisions to be retroactive, meaning that some taxpayers will be able to get taxes back now that they paid previously to create additional cash flow. So before we get into the income tax provisions, which will be the main focus of this, just some high-level items that were included in the CARES Act. Expanded unemployment insurance, meaning those that qualify for unemployment will receive an additional $600, I believe, for a period of time. There are a lot of emergency lending programs out there. I'm sure most of the people on here have heard about them. The biggest one, the most popular one at this point, being the Paycheck Protection Program. I think the biggest piece to that is that it might be forgivable in certain instances, so essentially could be treated as free money. That's for small businesses. They ran out of money with the first round of funding, but round two, it seems like is going to pass anytime now. So if you haven't been approved for that, I would definitely recommend looking into it now. There are other lending programs out there if you don't qualify for the PPP. So if you don't know about them, reach out to a professional or reach out to one of us at Wipfli. We have a big bench that can be helping you guys with this. And there are also other health provisions, payroll credits, and other items out there that everyone can be taking advantage of now. So before we really get into the income tax provisions, just wanted to touch base on this individual recovery rebate, which is also a hot topic that we hear about. $1,200 per individual that people could be getting right now, essentially treated as an economic stimulus. And it's based off of 2018 or 2019 tax returns. So it's meant for people, if you're filing an individual return, meant for people that have income of less than $75,000, or married filing joint up to $150,000. If you are over that amount, you start to get phased out, and you get completely phased out as an individual if you have income over $99,000, or married filing joint as $198,000. And just to point out, if you were under the threshold in either of 2018 or 2019, you should be able to benefit from it because it'll look at either of those years. And we just have a quick example of a slide. I'm not really going to go through it, but this kind of shows how the phase out would work. The married couple is over 150,000, so instead of getting the full, but they're under the $198,000 threshold, instead of getting the full $2,400, theirs is reduced by $1,250 in this example, so they're going to get about half of what you would think that they could get. With that, let's move into the income tax provisions of this. And Jim, I'm going to kick it back to you to go through this.
All right, thank you, Josh. So here we are. We're going to kind of get into the start of the meat of the opportunity to get back some of our taxes already paid. And Duane and Jeff, jump in here too at any time, and Todd as well. So one of the big main provisions is the ability to carry back net operating losses that arise in 2018, 19, and 20. And us real estate professionals know that happens when we do cost seg studies, 179D studies, make certain accounting method changes. We can generate big deductions and create losses. Well, under the Jobs Act of 2018, you couldn't carry back anymore, but you had to carry forward subject to an 80% limitation. Plus, on top of that, they threw an excess business loss limitation, which inhibited your ability to offset other income. So if you had a management company or whatever that was throwing off other income, you were limited to either $250,000 or $500,000, depending upon your filing status. Well, both of those limitations, the 80% is gone, as well as the excess business limitation for 2018 and 2019. We put together a little chart. Then Josh is going to walk us through an example. So if you take a look, so on or before losses before 12/31/2017, you can only carry back 2 years and carry forward 20 years subject to no limitation. Well, 2017, it's gone, so we really don't have to worry about that. So, but after 2017 and before 2021, so 18, 19, and 20, we don't have a taxable limitation and we don't have the 80% limitation. But so the opportunity is now. It's for 18, 19, and 20. So for the current year, and Duane and Jeff are really going to get into that and really hammer that home. Beginning in 1/1/2021, we're back to the old rules as passed by the Tax Act. So Josh, do you want to give us an example as to what this means for everybody?
Yeah, absolutely. And a couple things just to really quick build off of what you had said, Jim. And this is available for losses generated from 18 through 20, so it's still available for generating losses this current tax year and carried back up to 5 years, which is great. And then one thing from one of the prior slides, there's generally like a quick refund tentative carryback form that you can file when you generate an NOL and carry it back to essentially get a refund right now. And the nice thing about that is it allows you to get that refund within a 90-day period, so it's really quick. But generally, it needs to be filed within 1 year of the year end of the loss that's gotten generated. So for 2018 tax returns, generally, this quick refund form to carry back these NOLs would have been due 12/31/19. They've extended that 6 months for now. So if going through all this, you realize, man, I have a loss in 2018, or I can generate a loss in 2018 that I want to carry back. In order to take advantage of the kind of quick carryback forms, you have until June 30th to make that happen. So I would definitely reach out to your accountants now to make sure that you're taking advantage of this. So now to go through a high-level example of what Jim was talking about. So this is a taxpayer that's considered a real estate professional. This is could be viewed as a real live example. of someone's situation in 2019. So before the CARES Act, they had various different types of income. They had wages or commissions of 500 grand. They had some small interest, dividends, and capital gains. And then they had a lot of losses from rental real estate. And so it would have generated a total loss of a little over $1.4 million. But as Jim had alluded to, that loss can only be carried forward. So you can't use it to go back and get credits for prior taxes paid. And there was a limit to that you can only offset 80% of future income. So historic non-taxpayers, actually, it turns you into a taxpayer because you would have been paying tax on 20% of your income. Now fast forward to what happens after the CARES Act. So very similar fact pattern. You'll actually notice without doing a whole lot, their rental losses increased, and we'll get into how that happened in a future slide. But additionally, so they've generated a $2.6 million loss, and now with kind of these limitations gone, they are able to take that $2.6 million loss and carry it back 5 years and get refunds on any taxes paid for those 5 years. So before CARES Act, there was no benefit. After the CARES Act, and we have a little slide or piece at the bottom, a table that kind of shows taxable income and taxes paid. The way this works is you actually carry it back to the earliest year, to 2014 first. And so in this taxpayer's example, by generating this $2.6 million loss, primarily from rental real estate, they're able to go back and claim $780,000 of tax refunds and get that immediately in their pocket. And another advantage to this carryback also to keep in mind is that when the tax law changed at the beginning of 2018, tax rates went down. So you're actually able to generate a loss now with lower tax rates out there and carry it back to 14 through 17 when we had higher tax rates. So you'll actually notice, like in 2017, this taxpayer had less taxable income, but they paid more taxes. So you're going to actually get back more cash because you had a higher tax rate in that year. So just a high-level example of some benefits out there right now, what you can be getting.
And you want to just emphasize the significance of being able to go back that far. Normally, you've got a statute of limitations that prohibits you to go back that deep and amend prior tax returns. This seems to go back 5 years, back to 14. That's crazy great.
Yes, it's awesome. And the prior rules never allowed that either. The prior rules, it was always 2 years, which was within the same statute. So great point. So now I think we want to talk about how you could potentially generate some losses. And Jim, I'm going to throw it back to you.
Right. So here's another big benefit, or we're going to call it bonus, because under the Jobs Act in 2018, what they did is they provided for 100% bonus depreciation, but they didn't include in this qualified improvement property, which is any improvement to commercial property, non-residential property that you owned, but made improvements to the interior. That was an oversight by Congress and everyone, and they should have included that into 15-year property. So that would have made it eligible for the 100% bonus. And we had many clients that we did cost segregation studies for, and that we just could not take bonus for that. Well, so what they did in the CARES Act, they said, no, qualified improvement property, which is any improvement to the interior of a commercial building, non-residential, that you had it classify as 39 years. Now you can classify it as 15 years and now take 100% bonus. And this is a big provision for us. So this is something that we are actively doing for our clients right now. For everyone, that we did a cost segregation study in 2018 and 2019, and it's available for 2020. And Duane is going to get into some of his slides and examples on this. This is a very significant change, and so you can generate additional losses and now carry it back to make your NOL that you originally reported look even bigger, and we have many clients that we are doing this for. So Josh, do you want to walk us through an overview, and then Duane, introduce yourself and go through your examples?
Yeah, no, absolutely. This is an example of a cost segregation study that was done in 2019 for a retail strip in Chicago. The purchase price was $10 million. So without a cost segregation study, $10 million would generally be depreciated over 39 years, meaning that the taxpayer is going to get about a deduction of $250,000 a year. So it's okay. By doing a cost segregation study, you can then carve out all those costs into different buckets that are then depreciated over different lives. And as Jim had alluded to, anything that has actually it's a 20-year life or less, actually is eligible for 100% bonus depreciation, meaning you can take the entire deduction right now. So post-cost segregation study, 70% of the cost was still in the 39-year bucket, but 30% of the overall cost was carved out into 15-year, 7-year, and 5-year. And just to also mention, before the qualified improvement property change, actually 1.2 million of it, 12%, would have been 39-year property. But instead, that $1.2 million can be deducted immediately. So by doing a cost segregation and also taking advantage of the new qualified improvement property rule change, a taxpayer in this situation would get an immediate deduction of just under $3.2 million, which could help generate NOLs and help generate immediate cash flow.
Josh, what does that equate to in reducing or putting cash in your pocket? A $3 million deduction equates to roughly what in actual cash in the taxpayer's pocket after they go back and fix their prior returns?
Yeah, and I mean, it's obviously this is an estimate because taxpayers are at different rates, but and especially if you're carrying it back to 14 through 17 when the higher rates were in existence, I had estimated some of our clients are at 30% effective rate. It might even be higher than that. So in your example, $3 million of deductions could equate to close to $1 million of cash in your pocket.
And Jeff, we certainly have clients where they're going to get refunds like that. And we're already working on clients now that are, very, very, very substantial. That's why this is so important for people that own real estate to understand this and take advantage of it.
Duane, turn your mic on.
We still don't have you, Duane. It's in the upper, there's an upper circle.
No sound from Duane still. Try one more time.
Should be a blue circle that pops up.
Yeah, he's still nothing. Do you want to try logging out and log back in? We'll cover for you.
So one other thing real quick to mention about cost segregation studies and benefits, well, a huge advantage to doing it right now. It's also possible, if you haven't done it on prior acquisitions, just to mention it, that you can, even if you acquired a property back in whatever, 14, 15, any year, you can do a cost segregation study and then file a method change in your kind of current tax year to claim catch-up depreciation. So you could get a lot of extra depreciation on prior acquisitions as well if you haven't taken advantage of this yet. So something to really think about.
Any luck there, Todd?
You're all set.
Am I
Fantastic.
in? Awesome, cool. All right. All right, let me jump in. Yeah, this slide's a little premature. First of all, I just want to say thanks to Todd and Jeff Johnson, the entire Minnesota Real Estate Journal. Awesome converting from your physical to online environment. Happy to be a sponsor and be involved, but congratulations to you guys for getting this stuff set up. So let me jump in and kind of give you a little color as to how we're looking at the CARES Act. Now, NEI Legacy, we're a little unique in that we're both a landlord and we're a brokerage company, okay? So NEI, we have, over 6,000 brokers around the country. And so I've been looking at this CARES Act and how we can use it for our real estate portfolio as a principal, but then also as a service company at NEI and how we can help our clients at NEI. So what I've put together is a few specific examples. And now let me just kind of dummy down how I read the CARES Act. And again, much like everybody on this call, I'm a CPA. I no longer practice, but I practiced back in the 80s. So as I look at the NOL, and the reason we're talking about cost segregation and the reason we're talking about bonus depreciation is because how bonus depreciation creates net operating losses, okay? Right, it's the most powerful tool we've always had in our industry is this ability to use depreciation to create losses and candidly paper losses. So as I look at the NOL provisions of the CARES Act, I simplified it down to really 3 buckets, okay? And I want to talk about the third bucket the most, but I'll talk about the first 2 just by way of background. So I think there's 3 buckets we all have. The first bucket is the fact that many of us already have NOLs on our books. Most of us are landlords. I have NOLs on my books, and they're net operating losses that prior to the CARES Act, we weren't able to utilize because we couldn't carry them back. That was taken away from us in 2017 in the Tax Cut and Jobs Act. And there are limitations as to how much we can use in any given year. So the simplest bucket or the one bucket is just existing NOLs, and that's pretty easy. Call Josh, call Jim, and you can take those existing NOLs and carry them back 5 years. So that's bucket number 1. Kind of push that to the side. Now you got bucket number 2, and that's what Jim and Josh were just talking about. This fact that in the CARES Act, they're allowing us to kind of reshuffle the deck. So we get to look at the qualified improvements that we've put in service the past 2 years, and we can move some of those qualified improvements from 39-year life to 20-year life or 15-year life or 7-year life. So I kind of call that bucket NOL expansion. It's NOLs you can create if you're a landlord or a property owner from your existing portfolio. So those are the first 2 buckets. And I know Jim and Josh and a lot of their clients are taking advantage of that. We're doing the same. So those are the first 2 buckets. Now you have this new bucket that is tied to the CARES Act, and I'm calling it new NOLs, or NOLs that we are going to try to create for purposes of taking a loss and carrying it back. And this is pretty unique in the CARES Act in that NOLs, and imagine this, and I think about a lot of our NEI brokers and brokers in general are service providers, whether you're a contractor, an engineer, you're an appraiser, you're a banker, you're Jeff Peterson. We've had a pretty substantial bull market in this industry the last 5 years, right? And a lot of us have paid taxes, especially brokers, and maybe that's a Schedule C, maybe it's a 1099, maybe it's a W-2. Imagine now if you can create an NOL, a net operating loss, mostly from bonus depreciation, and use that NOL and go back the past 5 years and recapture all the taxes you paid. And that's kind of what's in this act. And that's that third bucket, is how does one create an NOL, good news, and carry it back? Bad news, how do I do it in the next 8 months? Because as you saw on the slides, this NOL carryback provision expires on 12/31/20. Okay, What's a little bit unique about NEI, and Jim knows this because Jim and Jeff and I go back almost 20 years, same with Todd. I've known Josh just recently, but, we've been fortunate at NEI when the Tax Cut and Jobs Act went through in December of 17, that gave rise to bonus depreciation for acquisition companies. Prior to that, for the most part, bonus depreciation was limited to developers, and there were limitations as to how much you would receive. But in the Tax Cut and Jobs Act, for the first time, one could buy a building, an existing property, and use a cost segregation study to create bonus depreciation. And I think, Jim would attest, I think we may have been the first company here in the Twin Cities to roll out a bonus depreciation platform. We closed our first deal 60 days after the Tax Cut and Jobs Act in February of 2018. So here's what I've prepped for the webinar is a few specific examples of deals that we have already closed at NEI, taking advantage of bonus depreciation, and also deals that we have in our pipeline to take advantage of bonus depreciation, and how I think you can use these examples in your own portfolio or maybe in your own relationships to create some bonus depreciation. So I picked a few examples by sector type, and kind of backing up again, when we rolled this first deal out, this one closed in, this one right here, this is on 24th and Cedar here in the Twin Cities, an industrial deal that was pretty unique because it's refrigerated and cooler industrial space. So we had a lot of personal property that qualified. But this was the first deal we closed in February of 18, and we've closed about $100 million of bonus depreciation cost segregation deals since. And again, all prior to the CARES Act. And then all of a sudden you look at the CARES Act and realize that the tool that we can all deploy or take advantage of is bonus depreciation. So let me just take a few minutes to walk you through some examples by sector type. And again, this is a deal we closed in February of 18, $5.6 million industrial deal. And the way it works is you first delineate between land and building. That's step number one. And in this particular case, this building is kind of last mile warehouse. The land is very valuable. So we had a little higher allocation to land. So $1.2 million of the 5.6 was allocated into land. Okay, then what you do is you take that $4.4 million pot and you go out and you hire a guy like Nick Hempel at CBIT or at Wipfli, or someone that can do a cost seg study. And Wipfli's done a lot of my cost seg studies. And what Nick will do is he'll take that 4.4 million and then he'll do a cost segregation study and he'll allocate it between real property and personal property. Okay, and personal property is 20-year, 15-year, 7-year, 5-year. And in the case of an industrial building, it's HVAC units, it's the landscaping, it's the sidewalks, it's the dock doors, it's the levelers. So it's all of the personal property that happens to be attached to that building. And all of that falls into a category that qualifies for first-year bonus depreciation. So in the case of this particular deal, we had $1.3 million that was allocated to personal property, 100% right off the first year. Okay, and then in addition to that, step 4 is you still get your real property depreciation on the 3.1. Again, that's a divide by 39 and the number of months you're in service. So a quick conclusion on an industrial deal, in this particular case, we did lever it 80%, but we got a almost $4 million first year write-off on our tax returns, which represented about 24% of the total purchase price. But probably more importantly, for every dollar we invested, almost 1.4 times depreciation benefits. So pretty substantial in the industrial sector. So that's just
Duane,
one example.
Let me just jump in. I mean, your third category here really is it's the bonus depreciation promised land. It is unbelievable because your cash into this deal was $1 million. Your deduction, if you will, is 1.4. You had basically no money into this after tax.
Again, everyone's situation is unique, but you're correct, Jeff. That's the beauty of this whole program with bonus depreciation. And what I think everyone can attempt to take advantage of the next 8 months is dollar in, again, depending upon your tax rates and what your tax return looks like, you take that $1.4 million and you offset 1099 income or W-2 income, and you're correct, depending upon your tax bracket, your effective cost into some of these deals is sometimes 60, 70, even, cents on the dollar, Jeff. So good point. And yeah, industrial just happens to be an asset class. Most people don't know this, that qualifies anywhere from 15 to 25% bonus depreciation. And my last slide kind of shows averages per sector. So this is an example of an industrial deal that we did close here in the Twin Cities. Let me go to multifamily, because multifamily is, from a bonus depreciation standpoint, an awesome asset class. Now, this is a deal that we closed here in the Twin Cities. We broke ground, and I had a partner in this deal that did the development. We broke ground back in 2018. But this, fortunately for this group, my investors in this deal, we actually placed it in service in March. So it became a qualified asset in 2020. And now this had a lower leverage, so the depreciation to equity ratio is different. But just again, to walk you through the numbers, a $39.5 million apartment complex in Robbinsdale here in the Twin Cities. The land was about $3.5 million. The building was $36 million. And again, cost seg study, where we delineated between real and personal. And in this particular case, $10.8 million of our basis qualified for personal property. 100% of that will write off in 2020. And again, we still get to depreciate the real property, in this case, over 27 and a half years. So you can see on a $17 million equity investment, almost $12 million of first year depreciation benefits, because we write off 100%. This one is almost a tax case study because it also falls into an opportunity zone. So the $17 million of equity in this deal is tax deferred. So a pretty crazy deal where we managed to take opportunity zone capital and defer the entire 17 million, because that 17 million come from capital gains events. And now we produced about $11.5 million of bonus depreciation. So if you're a multifamily owner or landlord, or you're putting multifamily in service, you'll find that bonus depreciation falls in about the 30% category, 25 to 35%. Okay, the next one that we have in the queue, if you're from the Twin Cities, most people know this building. This is the Restoration Hardware property that was just developed in Edina, intersection of 69 and France, probably one of the best intersections in Edina. And kind of the same thing. This is an asset. Now, this is a sale leaseback deal that we put under contract in December. We actually haven't closed this deal. We put it on hold because of COVID and working with Restoration Hardware on this deal. But pretty unique deal because it's about a $30 million asset. If you've been in this property, you know that it's chock full of personal property. In this case, on a $26 million building basis, back to step one, we have almost $9 million that fell into the personal property category, all of which we're going to write off in 2020. Okay. And this particular deal, Restoration Hardware, if you're not familiar with them, they are a big publicly traded company. Like a lot of companies, they've taken some hits with the COVID on their stock, but still a multi-billion-dollar equity company. Largest shareholder is Berkshire Hathaway. So we're still very bullish on the property, and we have a 20-year lease. So pretty unique to find a 20-year lease with a creditworthy tenant on a property that this one has $12 million of equity room in the deal. A lot of it is 1031 money. But now we have several customers that are calling that would like to get in this deal purely to take advantage of bonus depreciation under the CARES Act. And again, this is a deal, we're taking orders still on this deal. You'll find it at legacyofferings.com. But for every dollar invested, Jeff, kind of to your point, you'll have almost 80 cents on the dollar in bonus depreciation. And so what we did, go ahead.
You're into this deal for almost nothing. 20 cents on the dollar is your equity infusion after you go back and amend your prior tax returns.
Yeah, and again, every taxpayer situation is unique, but you're correct. Assuming all else is equal, you put $1 in this deal, and we're going to give you 80 cents of bonus depreciation. You take that 80 cents and you carry it back, and you recapture taxes. So, yeah, you're correct. It's an interesting way to go back. And again, it's a one-timer. We have 8 months to take advantage of it. So this is a pretty unique deal here in the Twin Cities because you get a 20-year lease on an awesome intersection. and a credit-worthy tenant. And we did, Jeff, on this deal. You'd appreciate this. And Jim has done most of my DSTs. This is a Delaware statutory trust. So we have it set up in a legal entity that allows for 1031 money in addition to now bonus depreciation money. And again, I think about half of our clients that are looking at this deal are actually doing a 1031 into the DST.
Duane, you've got a lot of tax bells and whistles here. You've got the bonus depreciation, you've got the DST structure to allow 1031 entree, but does the deal make good business sense without all of the tax attributes? What's your cash on cash return on that?
You know, this particular deal, only because it's been repriced, has about a 6% cash on cash. And in some ways that sounds low. The flip of it is, I'm looking at my screen right now, the T-bill, the 10 years at 0.6. So it's a pretty compelling cash on cash return, Jeff. And kind of to answer your question, nobody should make an investment decision purely on taxes, right? But in my opinion, it would also be silly not to think about the tax benefits on any investment. And again, as Josh and Jim alluded to, this NOL carryback opportunity, I think they used the word free money when they started the presentation. I'm not saying it's free money, but it's a one-timer. It's a one-timer, and it's an interesting tool that Congress has used in the past. Most people forget that the Obama administration had a 5-year NOL carryback in response to the financial crisis. And it was just a small window, and there were limitations as to what size company and what size individual could even take advantage of it. The Bush administration back in 9/11 did the same thing. They did a 5-year carryback provision in response to 9/11, but again, it had limitations as to what type of company could use it. And that's kind of what we have here today. The one thing that is pretty unique about it, Jim and I were talking about it offline, is that this NOL carryback has very few restrictions or limitations as to whom could use it or what type of entity can use it. So I do see it, Jeff, as really a one-timer. And so, again, when I look back at our clients at NEI, many of our clients would actually prefer to own their own building. And we have guided clients through deals where we have helped them get all of this bonus depreciation benefits. They own the asset 100%, but NEI retains kind of an asset management role and a tax prep role in the deal. And then we have other clients that maybe have $100,000 to invest, they're all accredited, or $200,000 to invest, and they would love to own something like this and have a 20-year lease, kind of mailbox money. And so we put them into a structure, a Delaware statutory trust structure, Jeff, to take advantage of it.
Hey,
Just as a sort of a political commentary, if we didn't have these extra little tax bells and whistles in these uncertain times, a deal like this might get put on hold or never even happen because people can't muster the courage to move forward on a deal when the economy is in flux and we're uncertain as to what's going to happen. So for the critics that say that this provision is just a fat cat tax loophole, I really think we need to say, look, deals were going to stop happening without these extra inducements. Deals were going to stagnate, and then we all suffer much more. So there is a real practical reason for allowing people to accelerate their deductions and motivate them to move forward. Do you agree with that?
Yeah, I totally agree. There was a New York Times article that already appeared in response to the CARES Act suggesting that this is another gift to the real estate industry, and real estate tycoons are the only winners in this NOL carryback. And, my counter to that, Jeff, is that one thing about real estate professionals, we're very entrepreneurial the way we're set up. And in order to generate an NOL the next 8 months, a taxable event has to occur. One has to place a property in service in order to generate bonus depreciation. You either need to develop it or acquire it. And if you place a property in service, think about it this way. Nobody talks about tax neutral. When we close a transaction, like some of the deals on this slide here, and this is kind of the play of the day, some of these essential categories, but even take our restoration hardware deal, you close a deal like that, and guess what? A broker gets paid, and that's taxable income. A banker gets paid, and that's a taxable income. Appraiser gets paid, and that's taxable income. Everybody forgets about all the service providers that receive fees and income when a transaction closes. And guess what? They pay taxes on all that income. So that article, when I read it, it suggests only about the savings side of a transaction. I kind of see this as a call to action to the real estate industry. The best thing that could happen to America, candidly, is if we end up with $100 billion of tax savings through NOL carrybacks on new deals, because that means $200 billion of deals closed.
And
a lot of fees.
Yeah, my point is earlier when I started about the free money is free in the sense that you don't have to pay it back, right? It isn't a loan. You don't have to pay interest on it like you do a EIDL loan, and you don't have to worry about meeting a formula for forgiveness under the PPP loan. It is your money. You pay taxes on it. The government's giving you a chance to go back and get your money. So it's great. And Duane, I think those slides are awesome.
Yeah, and I'll jump forward here. I know we're running out of time, but yesterday Brookfield, Brookfield is one of the largest owners of real estate in the country. They announced a $500 million fund to acquire essential real estate. It's a word that all of a sudden the last 60 days has become somewhat overused in the industry, but it's pertinent because essential real estate and the major food groups are food, fuel, and pharmacy. Those assets have become the preferred assets just in the last 30 days in particular. That Brookfield fund is set up to only acquire those type of assets. And one thing pretty unique for everybody on this call thinking about the CARES Act, essential real estate, when you look at grocery, pharmacy, automotive, they just happen to be assets that have tax attributes that are actually pretty compelling for bonus depreciation. Okay. And we just closed a Walgreens in Anoka recently. That Walgreens had bonus depreciation close to 30%. But when you look at these percentages on the right-hand side, that's why these essential properties, I think, will be in favor the next 8 months for individuals that want to take advantage of trying to create an NOL, because they are compelling. Most of them are 10-year plus leases, but they also are assets that can take advantage of bonus depreciation. And here's kind of my final slide, then I'll kind of hand it back to the group. But these are just some ranges that you can all look at by category. Obviously, hospitality is another high-end bonus depreciation asset, albeit kind of a challenging asset to acquire in today's market. Office medical has a high percentage, but when you look at ranges that you can expect if you're buying properties, these are the ranges that Wipfli and myself have kind of kicked around as bonus depreciation.
Duane, I think you want to create a whirlwind of velocity in the marketplace. And when we have stagnation, nobody wins. The local property tax assessor can't raise the taxes. No one's getting paid on any deals. But when you stimulate purchases, that's going to cause the seller to then have a motivation, and it kind of becomes this compounding benefit to society as a whole. And there is an intrinsic interconnection between real estate values and job growth that no one can really quite explain. But when we have velocity in the real estate market, we tend to have lower unemployment. And if anything is needed at this moment in time, it is to deal with the displaced employees from the service sector, like restaurants, cruise ships, airlines, and motivating people to acquire real estate is going to help alleviate that unemployment as a big picture goal here for society as a whole.
Yeah, don't disagree. And of course, Jeff and I have been talking almost every day on clients that are, first of all, we're going to talk about 1031s in a second, but people that are trying to understand how bonus depreciation works. And Jeff, you're spot on. Again, I think it's almost incumbent upon all of us in this sector. Let's do deals. Let's get stuff done the next 8 months. There's a huge tax benefit to doing it. And if we do it, this industry kind of is a leading industry to get us through what is a pretty difficult time right now. Don't disagree.
All right, Josh, do you want to cruise through 163? Jay?
Yeah, I'm going to cruise because I know we want to get to 1031. And Jeff, FYI, you were muted just now, so you need to unmute yourself somehow. Yeah, 163J, this is the interest expense limitation that was enacted with the Tax Cuts and Jobs Act, which essentially only allowed taxpayers to offset or to deduct interest up to 30% of their taxable income. So it really limited them. So they changed the law for 19 and 20 to increase that limitation to 50%. There are special rules for partnerships where this only applies to really 2020, and that's all I'm really going to say for now. The one thing to keep in mind from a real estate perspective, though, is that there is and has been an election to opt out of these rules, the 163J interest expense limitation, if you're considered an electing real estate trade or business. So you weren't subject to the interest expense limitation, but what it did was it changed your depreciable lives for your real property and your qualified improvement property. So if you made this election, your qualified improvement property, which we've been talking about as now 100% deductible, had to change to a different method, alternative depreciation system, where actually bonus depreciation isn't allowed, which is a problem. So what they've also come out with is that taxpayers that have made this election in the past are able to either amend returns or file method changes to revoke what was previously an irrevocable election, so they can now take bonus depreciation on qualified improvement property. And that's all I'm really going to say for now. There are a lot more things in the CARES Act. For federal purposes, 2019 tax returns that were due on April 15th were pushed to July 15th, as well as Q1 and Q2 payments. Everyone should be aware, state conformity, double check to make sure that your states have complied with what the federal government did, because some of them still have, for example, Q1 or Q2 payments due at the original time. But we want to move to 1031, so I'm going to hand it over to Jeff.
Thank you, Josh. You know, I'm in the trenches every day helping people facilitate 1031s. I'm a humble administrator of 1031s. My background is I'm an attorney, adjunct tax professor, and an educator, but really I'm in the trenches with small mom and pop investors all the way up to the big mega corporations, helping them facilitate exchanges in the capacity as a qualified intermediary, or in the context of reverse exchanges or construction exchanges, we act as an exchange accommodation title holder. Now, everyone was anticipating that the Treasury would allow greater extensions when the federal emergency was declared back in March. But nobody really knew how they would be implemented. During Katrina and forest fire nationally or presidentially declared disasters, the extensions that were given to those affected taxpayers were much more broad than what we got in IRS Notice 2020-23. And what that basically did was extend the identification period or the exchange period to July 15th if your applicable deadline, the identification deadline or the exchange deadline, occurred between April 1 and July 15th. Well, you know, that's great for some taxpayers that are just kind of getting started or wrapping up their exchange, but it hasn't really given the benefit that people really needed for ongoing exchanges, people that have exchanges going on prior to the COVID pandemic. Here's an example. You listed a hotel as your replacement property when you identified in November of last year. Well, the economics of that hotel has changed dramatically. Occupancy levels that may have been at 90% are now below 10%. Cash flow on that hotel is not looking very favorable. So do you forego the 1031 exchange and not buy your identified replacement property? Well, that is the hard decision that people are having to make. And the extensions that were granted in Notice 2020-23 don't help people that already had ongoing exchanges that are trying to decide whether to pull the trigger on that acquisition. A better way would have been to extend the period longer or allow people to go back and change their identifications to buy in a more suitable replacement property in this context, the context of a completely changed economy. Also, folks that were doing exchanges early in the year and had to identify replacement properties before April 1, many of them were under stay-at-home orders. If you were in San Francisco and you were in a stay-at-home order, you could not get out and look at suitable replacement properties to try to identify them. And if you were trying to buy multifamily, guess what? The tenants in those multifamily buildings were not allowing potential purchasers to come in and inspect the units because they were afraid that they'd be infected by having human contact with people that would come into their residential units. So it was a really tough time for people, and these extensions haven't really benefited people that are doing 1031 exchanges to the extent that they could have. And then the last point on this slide that I want to just mention is the notice 2020-23 came out, in that like second week of April. Some taxpayers had their 180th day occur before notice 2020-23 was published or announced and had received their unused exchange funds back after April 1. Well, how do you deal with a 1031 exchange that's now been extended out to July 15th, but the taxpayers already properly received their funds back before the notice was published? Creates a huge problem if you've already got your funds, you've already got actual receipt of your funds, to now say, I'd like to continue with my exchange to the extended period. One more point that I just want to make on 1031 exchanges is that the Treasury has been receptive to the industry. The American Bar Association, the American Association of CPAs, the Real Estate Roundtable, the Federation of Exchange Accommodators has been trying to communicate that the extensions that were given were a good start, but we'd like to amend that notice. And the most important thing that they're looking for is to back the starting date for the extensions back to March 13th rather than April 1, and to make the extensions 120 days. So if the end of your identification period or the end of your 180-day exchange period applicable to your like-kind exchange falls in between March 13th and July 15th, they want to extend it to either the greater of 120 days or July 15th. That will give people time to muster the courage to get their deals back on track and finish, so we have more transactions actually occurring. The extensions that we got were a good start, but they're not really going to have the stimulus effect to actually help people get deals done. And therefore, these very influential groups, the American Bar Association Tax Committee, the Real Estate Roundtable, they're all trying to express some common sense desires to broaden the extensions to allow more deals to get done. And that's pretty much the commentary from the 1031 field. We are still seeing a lot of deals going on, but there's a lot of uncertainty as to whether or not those 1031s will actually get completed. And people's confidence to pull the trigger on a purchase is basically squelched at this moment in time. So that's the commentary on 1031.
Great. So we only have a couple minutes left. Josh?
Yeah, let me jump in quick, Jim.
All right.
We're going to, for the sake of the fact that this is being recorded, so you'll be able to find this on our YouTube channel, we're going to go a little bit longer and get to some of these questions in the chat room. There are about a dozen really high quality questions in there. If all of you are okay with that, we'll continue to go. If you're watching online and you have to sign off because of another appointment at 10:30, I understand that, and we will record it and have this available for you. So a little bit extra time, Jim, so go ahead and finish your thought.
Yeah, so on our slides, Josh has some on the OZ zone. So if you ask for the slides, his his comments will be on there. I see a number of folks asking for the slides, but not providing your email address. So if you provide your email address, we will make sure that our marketing folks get you the slides. And if we don't get to your question, we will get back to you and answer your question sometime next week.
Or please feel free to reach out to us directly.
Yes,
as well.
exactly.
All righty, let's go to the questions.
All right, let me just give me a second here to regroup. I'm just going to leave Jeff's pretty shot up on the screen for a while we do this.
He's a handsome devil.
I know, isn't he? When you purchase, this is Scott Berman. When you purchase a property with a 1031, isn't the basis from the previous property, assuming you exchange into it? So would these items you're discussing work? So if I have a low basis property and I trade into a deal, am I still going to be able to get some advantage?
Well, if you buy a more expensive property, you're going to pick up more basis. If you lever up into your new property, you're going to pick up basis. If you just exchange into a lateral, an equivalent valued property, your cost basis is going to be augmented down by those deferred gains. And I can tell Jim wants to jump on that as well.
Oh no, yeah, and Jeff and I work on a ton of deals together, and we've always taken advantage of that. So to the extent that you go up in value, you have to carry over of basis, but to the extent you go up in value, we've been very fortunate to allocate over to shorter life property, because usually that's where the increase comes from. Obviously, land may be a slight component of that, but generally speaking, yeah, we've been able to take advantage of bonus depreciation on 1031 exchanges.
And people talk about a distinction between 1245 property and 1250. If you buy the replacement property and say this entire property is real estate for the purpose of my 1031 exchange, and then a week later you do your cost seg and you're breaking out these components, these fixtures, you can still treat it as personalty for the purpose of your bonus depreciation, but for state law purposes, it's still real estate for the purpose of satisfying your 1031.
Right, and so what we generally do, depending upon the length of the hold, I mean, the value of that 1245 property may be worth zero, because if you've held it five years or longer, it has zero basis, and the tax code and particularly the regs, qualify that, the value of that property could be worth zero. So when we transfer it over and we trade in, we're finding a whole bunch more of 1245 property.
And I was thinking about more in the context of the replacement property being all real estate on the moment of acquisition.
Sure. Yeah, absolutely.
But you're right. You got the same issue on the other side. You may have to match up 1245 property with 1245 property that is both real estate. Todd, you've been involved in some challenging projects where folks had a lot of 1245 components that they needed to match up on their replacement side. Could you speak to that challenge?
If you're living in the cost seg world, so you've done one of these before and this is not new to you, you absolutely have to call Jeff Peterson and Jim Lockhart before you do any deals, because it is the devil's in the details for sure on these unqualified property. You can solve it. And Jeff, we've solved for X a couple of times. It made really cool transactions, but you can't do them by the seat of your pants for sure. I got another question here. This is a good one. David Denton. And I'm not going to give you business advice, but he says, what is bonus depreciation average percentage for hotels?
This is Duane. I had one slide. I'll tell you that 25 to 40% of your investment value, and probably towards the higher end of that range, Todd.
Not going to say that it's bad to buy hotels.
No, I'd say on average, we're getting 33 to 35% broken down fertilized property that would qualify for bonus on average.
This might not be a bad time to buy a hotel or a motel.
That's true.
If you can repurpose it to maybe like apartments or something like that, or extended stay, you may be able to take something that's not cash flowing very well and enhance it by getting it to a higher and better purpose.
Okay, let's keep rolling while we're hot. Ted Blank. When investing in a DST, does the sponsor do the cost seg study or each DST owner? If sponsor does it for the whole property, do all DST owners have to follow that allocation?
So I'll jump on that one because we've done about 7 of these. Number one, the sponsor actually does the cost seg or engages the firm to do the cost seg study, and then each beneficial member of the DST can elect to use it. And the reason I say it that way, we've done some DSTs where some of our investors were 1031 motivated and some were BD motivated. So everybody can individually choose, how they take their basis and use it. But I would tell you that most of my clients take advantage of the bonus depreciation report. So it's done at the sponsor level. That's the good news.
That's pretty cool. I'm going to combine 2 questions together. Biju Matthew and Jay Marr are talking about the qualifications for taking this bonus depreciation as an individual. So partner in a partnership or however we get it. It's all good, Jim. But this question's for you. Please clarify if you need to be a real estate investor. What are the qualifications as an individual to be able to take depreciation against other types of income, so my salary income or other things similar?
Well, can I start? And I know Josh will do a way better job than I will do. And I saw some other questions too on there, Todd, related to this about the passive. Has anything changed with respect to passive losses? The answer is no. So whenever we get a return or a question from somebody that owns real estate, whether it's a broker or whoever, it's like, well, how are you listed on your tax return? Are you qualified as a real estate professional? And oftentimes, surprisingly, the answer is no. And that's where we begin and say, okay, if somehow we can change your status to a real estate professional, now all the losses that you've been reporting as passive, you're now active, which is huge because now you can offset other types of income, right? It doesn't have to be just from real estate. It can be all of your income. So that's where this ability to carry back and get prior taxes paid is huge. That being said, some people are passive real estate investors, meaning they don't actively work in the real estate area, whether you own a construction company, a brokerage company, or your own brokerage company, management company, whatever. It's a very broad list as to who can qualify as a real estate professional. But let's say you don't, you're a passive investor and that's all you do, you are still able to offset other types of passive income. We had just before this webinar, had a very large multifamily developer out of New York City call and say, Jim, I got a ton of clients are saying, hey, how do I take advantage of this? And it's really, they can offset other passive income that they're in. And a lot of these wealthy individuals, that's what they do. They invest passively. They have income and they have losses. And so your losses in real estate can offset that other income that's being thrown off by other investments. So I don't know if that was responsive, but Josh, do you want to?
Yeah, no, that was great. Yeah, the only thing I'll add to that is at a high level, 2 requirements to be considered a real estate professional. One is more than 50% of your time essentially working has to be in the real estate field, real property trades or businesses. And 2 is that you perform at least 750 hours or more in these real property trades or businesses that you materially participate in. Very high level, there's some complexity to that, so don't just assume that you qualify or don't qualify. If there's any uncertainty, I would definitely reach out to Jim or I or someone else to make sure that you meet those rules.
Do not make that assumption on TurboTax, is what you're saying.
Josh, would that affect your decision was whether or not you wanted to buy a triple net or a double net kind of property if you're looking to actively participate in the management of some of your assets to substantiate the 750?
Yeah, I think so. Although there are ways to aggregate some of this stuff, but triple net lease, you're going to spend a little less time and it might be tougher to hit that requirement of being active. So definitely want to think through your acquisitions and kind of how you're spending your time on these different projects.
But also to add, Jeff, that's an excellent question, and Josh, great follow-up. There's also an ability to make a grouping election, so it doesn't have to be 750 hours for each investment asset. We can group all of your real estate activities and and count your hours that way. So the devil's in the details, but we work with a lot of people to try to get them qualified.
It's not the devil in the details. The pot of gold is in the details, baby.
Yeah.
Okay, I'm going to do at least one more here. I'm going to go 5 more minutes. Sherry Skeens, I hope I'm saying that right. What if you already did a cost segregation study? Are you able to take advantage of any components that may have been depreciated over 15 years?
Absolutely. Yeah, you can, for anything, you can make a method change, even if you previously did a cost segregation and didn't take bonus depreciation, for example. I think you can file a 3115 which is a method change form to kind of catch up on depreciation for anything that you might have missed out on, especially with like qualified improvement property, which wasn't subject to bonus depreciation until less than a month ago. So yes, you can still take advantage of it, but you should talk to CPAs about it.
Okay, Ryan Benton. I have a deal in the pipeline. 11 units are subsidized by the state. Do the same cost seg and NOL write back, I assume, and carryback rules apply to subsidized housing property? Units are Section 8. Real estate's real estate, right?
Yeah, no, it qualifies.
Yeah, I can't think of any real estate that wouldn't generally qualify for this stuff.
Exactly.
Are the OZ cap gain exclusion benefits getting extended with COVID? If not now, expecting that soon, will the tremendous delay of investment we will certainly see?
Yeah, and we didn't get to our op zone slides. The one thing that the government has extended, similar to 1031s right now, is if your 180-day period to reinvest capital gains kind of expired between April 1st and I think the end of June, or maybe until July 15th, it gets extended automatically to July 15th. So you get a little bit extra time. And that actually comes into play, I mean, for a lot of taxpayers, but there are special rules if you own an investment through a partnership interest where you might get more time than you might have anticipated. And there's also other reasons to be thinking about opportunity zones right now. I think we had talked about this the other day. There were people cashing out of the stock market unexpectedly earlier on this year, and they might be sitting on more capital gains than they had ever anticipated. And what do you do with that? So OZs might be something good to explore for that as well.
Another segment are the folks that are foregoing their 1031s, not buying those identified properties, and now they're having to deal with Plan B. And Plan B might be, let's put it into an OZ fund before July 15th. That works really nice if you've got enough proceeds. But for folks that are having mortgage over basis, they don't have the cash proceeds to reinvest, because under the OZ, you have to reinvest your profit or your gain, whereas under 1031, you just have to reinvest the net equity that came out of the closing. So there can be a mismatch. But if you want to go to the alternative to 1031, the OZ makes a nice, I guess, second place to get some deferral until 2026.
That's all the questions I can get to. I'm gonna claim a glitch here. I can't seem to get to the questions that were asked in the first half. I will email the questions to the 4 panelists, and they can address you offline anytime over the next week or so. I'll get that out right away, though. Final thoughts from everybody. I want to throw in quickly. I always feel like there's a segment of the marketplace, 30 to 40% of real estate professionals, that kind of catch on to the latest thing a little bit too late. And if I'm hearing what Duane and Jim and Jeff are saying, that there's not a long fuse on this. So if you're considering any kind of a tax strategy, it's time is now. Am I correct? Like, you need to get on top of this, and you need to get working on it today. Final thoughts. Let's start with Josh.
Yeah, final thoughts. It seems like there's been a lot of questions popped out of if I can take bonus depreciation and am I considered a real estate professional. Definitely reach out to us so we can talk about this now to make sure that you're going to qualify to take advantage of this. And we're happy to work through this with any of you guys.
Yeah, I'll jump in, Todd. You know, I was a CPA with Pete Marwick back pre-tax reform 86, and the better part of the last 35 years, always looking for an opportunity within the context of the code. Jim coined it, creature of the code. We're kind of all creatures of the code, but this is a little one-time opportunity. We have 8 months to take advantage of a gift that we were given as an industry in the Tax Cut and Jobs Act in 2017. And I call that gift this bonus depreciation rule. And combining that gift with now this NOL carryback that again only survives for 8 more months. So combining those two tools is a pretty powerful opportunity for everybody. And yeah, we're happy to help here at NEI in any way with your needs.
Jeff, go ahead. Jeff?
Well, if I was going to give some advice to someone right now, I would say, look at the slides that Duane prepared and look at the percentage that he had for gas stations. What's the term of art? Fuel, auto fuel accommodations or whatever it is. 100%. 100% bonus write-off if the real estate meets the criteria of that definition. If there's one thing that should get you excited, it's the possibility of buying a small gas station on a triple net leaseback and bonusing the entire cost of acquisition of those improvements. That should get you excited. That's the tip of the day.
Plus, there was a day last week when you could get paid to store oil when oil was at minus 40. So that's another bonus. Jim, final thoughts?
No, I agree with what everyone said here. And I know that the vast majority of people on this webinar own real estate. And I would certainly talk to your accountant or give us a call, anybody on this panel, and just see if you can take advantage of this, because as Duane said, this is a gift and it's not going to last forever. And it's if you pay taxes, it's your money, and we can help you go back and get it for sure.
Well, thank you, gentlemen. I'm going to let this the chat room roll for another 3 or 4 minutes for the people that are online. So I'll leave it open, but I think speakers, it's okay for you to sign off. Appreciate your time. This was very generous of all of you, and I can't wait to do it again. Thanks, everybody.
Thank you, Todd. Thank you, everybody.
Take care, everyone.
Bye now.